Welcome to the Daily Update. This is Being Prepared Thursday, June 30th, where we'll look at the action in the market today and then see how things look for Friday, July 1st. So happy July. And it was kind of an interesting day. We fell at the open, had a nice, impressive recovery, but then ended up giving a lot of that back. So things are still pretty negative overall when you try to evaluate where the S&P is at right now. So let's go back and talk about this. At the open, we saw a gap lower open, and we were quite a bit lower. Now, the ranges for the support and resistance levels, or the pivot points, were a lot smaller because of the short range that we had on Wednesday. That's how it gets its calculation. So it didn't take us much time to go right below S1 at 3,800, which is a key psychological level. And then we went down to S2 at 3781. And then I had to break out the old pivot point calculator again. And we fell all the way down to S3 at 3743 before staging a pretty nice bounce, coming back, a solid recovery all the way back to the unchanged level. So we thought, okay, we filled the gap, but are we going to continue going higher, or are we going to use the unchanged level as a resistance level and go back lower? Well, that's what we did. We ended up bouncing back from that. So we ended up seeing lots more selling, which took prices back down to S2, and then a real choppy recovery going into the close. We tried to bounce a little bit, but not all that much. We ended up being down 0.88% on above average volume. Now, it was the last day of the quarter and the last day of the month, so that might have something to do with the increase in volume. The technicals are pretty negative right now. We still have some possible positive setups, but at the same time, we need to see some follow through with price action. There's really no confirmation that those things are going to happen right now. And if you did get in based on some of those scenarios, you're probably looking at some losses right now and some real frustration as I clear my throat. But that's why personally I wait to see, okay, here we have a setup, and that's all it is. It's not a signal, it's a setup. And then once we see confirmation with the prices, then that's when we can decide, okay, I want to get in or not get in. The markets are still really fixated on inflation and interest rates, which produce growth concerns. All the different geopolitical things going on right now, not really playing into the market as a whole. There are some geo things that are happening that I'll bring up on the next slide, just with the economy and the banks in other countries, but not necessarily things that like the Russia-Ukraine war. It's still going on, but it's not really having an impact on the markets right now. Earnings as they are released, and then everybody's still going back and forth with this recession idea. So what can we say? Yes, it was the last day of the month and the quarter on Thursday. The markets will be closed on Monday for July 4th. So I want to just say in advance, I will be putting out other videos before that, but just have a very happy 4th of July or happy Independence Day, whatever you choose to call it. What happened during the night was China reported a weaker than expected manufacturing PMI. Now that's not that big of a deal. And China doesn't usually have a big influence on the markets, but it is worth noting. And they're becoming more and more of a bigger player as time goes by. Then Japan posted its weakest industrial production number since we went into the pandemic and all the lockdowns and everything. So Japan's really having some trouble right now too, which I've been alluding to in pretty much every video. And then Sweden got into the act. They raised their rates 50 basis points at their meeting. And you take all of this together and it provided a pretty negative backdrop for the markets. During the day, what kind of supported things is commodities and interest rates really started to fall. Commodities are more inflation. The stock market liked that. And interest rates, it costs more to borrow money. Both of those fell, and that really helped stocks go back up, but it didn't really lead to all that much in the end. The 10 to the 5 yield curve is still inverted. Fear is still extreme. And then we had the personal income and spending report. It showed a decline of 0.4% in real personal spending. I don't know, as opposed to fake personal spending, and a 4.7 year over year increase in the core price index. So we're seeing prices going up and spending going down, according to this. And that is usually what happens in a weaker economy. The Chicago PMI came in weaker than expected. They thought it was going to come in at 58.8. It came in at 56. And our trend is negative and weakening, but with the 2 down days, it's kind of starting to turn up a little bit. I've switched the bias to full-blown negative as well as the momentum. The momentum that we were seeing late last week just didn't play out this week at all. So let's go in and look at sentiment. We're back down to 23, which is extreme negative, but we can stay camped out at this level for quite some time. This is just showing that the buybacks are decreasing a little bit. It's peaking after recent highs right now. And this is the 4-week moving average, just to show. So you would think if you see this number really spiking up, that means people that work for the companies that a lot of you like to invest in, if they're buying stock, maybe it's a good idea for you to buy stock. If they're not buying stock, maybe you shouldn't either. So people use this as a way to kind of gauge what they're going to do in the markets. Then we have the S&P. It's moved hand in hand with the PE ratio in conjunction with treasury yields. And this dark line is the forward-looking PE, and that's what the market uses. That's not necessarily what I use when I'm looking at how the markets are currently valued. But as the yield has come down, the forward PE has also come down as well. Just something to make note of. Then they are constantly asking folks right now, when do you think the next US recession will occur? And as of June, the latest reading that we had right now, 71% are saying next year, 2023. You have 17% saying that it's still going to happen this year in 2022. And then you have a lot of don't know or a whole lot later on, or maybe into 2025. But right now, the consensus feeling is that if we do get into a recession, it'll be in 2024. This is showing the conference board expectations and the current conditions. When this really spikes up, that's usually when we're in a recession. And then we've been kind of coming down here with some problems. We spiked up again right after the COVID plunge, and now we've been coming down again. And here we have that. Oh, I hit the wrong button. That's why. So this is the EPS revisions according to different countries. The dark blue line is the S&P 500, and it's been holding up okay, but starting to roll over just a little bit. The stock 600, which is in England, that's the light blue line up here on top. You have the topics, which is the gray line, that's Japan. And then the bottom are emerging markets, and they've really been trailing off lately. And then this is the Fed funds futures curve rate, where it's just, what's it expecting? Where we have now is the dark blue line, and then a week ago was the kind of purplish line, and the expectations haven't really changed all that much. And then I have some more charts to show you later on. We're getting a little bit concerned about copper. Copper, it's called Dr. Copper, because when it's doing well, usually that means that the economy will end up doing well. When it starts breaking down, that means the economy might start breaking down as well. And here you have copper against gold, where this is the ratio with the dark blue line, similar to a lot of the charts that I do. And it just shows how copper has really been underperforming gold, which gold has been doing pretty much nothing anyway, where yields have really been going up. These tend to move more in tandem with each other. And again, I have some other charts to bring that out here later on. Then the continuous jobless claims. This is what people are pointing to, saying we can't have a recession right now. The unemployment rate's not very high. There are too many people, there's more jobs than people to look or to fill them right now. So that's one of the reasons that people are still kind of holding out hope that either the economy is going to get better or it's going to be further off into the future before we see any real problems. Then here's the composite index against the S&P 500, the EPS, and it just shows with the the dark line is the S&P 500, the year over year change. And here is the composite index, and they've both been declining together, where here they're seeing the estimate is this should continue to decline, which might roll over into the S&P 500, and that could put some further pressure on prices. All right, so the VIX, it went up a little bit with the decline, but not by as much as maybe you think it would. And the bar chart also showed an advance. And the VIX of the VIX still giving us a pretty low reading, and it actually was flat to slightly down on a closing basis. The Ulcer Index is coming back down more, so it's prices, or the fear gauge here is really not showing excessive fear according to this indicator. We had our AAII current release, and it still shows that individual investors are extremely pessimistic, and we often use this as a contrary indicator. We had the GDP now, which also was updated, and now they're actually saying that we might have negative GDP in the second quarter. So we have things that are all over the place. I showed you one yesterday that said we were up. The last time we came up with this chart showed that it was at 0. So it's really hard to get a handle on what's really going to happen here. We're down 21.44% from the all-time high. We saw actually a little bit of a decrease with the equity put call ratio on the daily chart, and a little bit of an increase on the 5-period chart that we have. I wanted to show this. This is the value index, and it's showing that we've now are seeing a death cross. So not only has growth really been having trouble in 2022, but now value is starting to assume a downtrend as well. Here are the new pivot levels for Friday's session over here on the side. I don't know, did some of you pause this and look at these? I thought about maybe putting all these numbers in a spreadsheet and making that available. I'm not really sure the right thing to do. Nothing really new as far as the daily chart. We were a bit above average on the volume, but we're below this pivot level and the new pivot for July, and we're above this previous support level, and S1 is now set at a little bit lower for the month of July. Here's the machine gun chart showing that we're kind of in between a couple of different support and resistance levels. And here's the same chart that is supposed to look better, but actually looks worse. We've dropped down below this full fib retracement from the March high to the May low. We came back up a little bit. Well, now we are down below that. And here is the daily chart with the new July pivot points. Fib retracement for going back to the 2021 low. This is showing that we still have some support right below where we're at about 37.20. But if we continue to fall, that's another 40 points from where we're at right now. We could break through this support. We did that before. We were able to bounce back up. But if we come back down again, are we testing, or are we just going to get ready to go lower? This is also showing that we have some overhead resistance where we're at right now, and we could potentially have some support, but that's at 35.14, which is a long ways away from where we're at right now. So that would mean a pretty significant decline. The weekly chart, nothing has really changed much. We still have the 200-week moving average right at the 50% retracement, and it'll camp out there for a while. We're still below this other 38.2% retracement. We were able to get that back and stay above that. Well, now we broke below that level. Our sectors, the energy sector was down the most. It's kind of all over the place, followed by discretionary and tech. There was one area that was up kind of strong, and that was utilities, up over 1%, but nothing really gangbuster in here. The energy sector is still showing us the best technical chart, followed by the utilities, and the staples are almost near 90, where the weakest technical charts are communication and discretionary. They are in single digits. This is the same thing that I've been talking about for quite a while now. The energy sector is the only one that's up, followed by, actually, utilities are up less than 1% now because they had a good day on Thursday. But all of the other sectors are negative. Technical alerts, most of them were negative and set earlier in the day, where the S&P dropped down below 3,800, and that's pretty much it for the S&P 500. Intraday, and I was a little late getting the screenshot for this, but we were down pretty heavily, and a lot of this weakness came in the overnight when things were happening in Asia and in Europe that took the futures prices quite a bit lower. So we ended up gapping down below we didn't even hit S1, came right down through S2, came all the way down to S3, bounced up off of that. And this was impressive to watch, but we stalled out right at the unchanged level, which was also the daily pivot, bounced off of that 2 times, came back down, tried to chop our way into the close and got a little bit of that back, but it was still kind of negative overall. Our trend, the ADX is starting to turn back up with the down days that we're seeing, and we are negative because the red line is on top and advancing and the green line is on the bottom and declining. The Arun is not changing. It's like this thing has gone comatose on us right now. New highs, new lows, seeing some weakness based on price and volume. The AD ratio continues to show weakness, and we're negative because we're below 0. New highs, new lows had been hanging in there, but now they're starting to roll over. We see some more follow through weakness. This is going to turn negative as well. Accumulation distribution, we're settled right on the moving average. Short-term charts, we're well below the rainbow now, and I'll probably take this one out if we see further declines from here. Force index showed a little bit of a decline. And the Swindling Trading Oscillator is also showing a decline based on price and volume, and we've actually dropped below 0 with the volume. McClellan Oscillator has switched even more negative than it was before yesterday, seeing some weakness in the 20, 50, and 200 period moving averages. Stochastics are kind of bouncing around. They're not quite sure what to do in the short term, rolling over intermediate term and still positive, but starting to roll over with the longer term stochastics. Intermediate term, the PMO is still positive, but we see some more follow through downside. This is going to quickly switch back over. We're already starting to roll over based on price, and we still have not gone positive based on volume. The PMOs that are rising is now declining. The buy signals continue to advance, and we're flat with those PMOs that are above 0. Chaikin Oscillator also shows weakness. Chaikin money flow just kind of not really much right now. We picked up a little bit in volume, but it didn't really register in this indicator. The vortex is still negative. The summation index is declining based on price and volume. And we're still kind of seeing a mixed bag here. Slope is still positive, but that could change. The MACD's hanging in there. KST and Tricks, they're trying to go positive, but they may not be able to. The PMO is positive, but could roll back over. And the TSI is also positive, but could roll back over. The BPI declined a little bit and not necessarily extreme right now. The rate of change going back 50 periods is still giving us an extreme negative reading. Ease of movement actually ticked up a little bit. TTM squeeze, still trying to show a little bit of improvement as this histogram here is showing a bit of a rise, but we're just not seeing that with prices. The Heiken Ashi has turned more negative now than when I did yesterday's video. The Kegi is still positive, but we see any more down action and that could switch over to negative. The Renko has redrawn and is actually looking a little bit more positive. It liked that rebound that it saw during the day, apparently. The point and figure chart is turning more negative, and that positive signal that we saw before, it's gone now. We don't have a new signal, but we have 3 new zeros that are being plotted on this chart. The elder for the S&P has switched to negative, as has the SPY. The SAR is still hanging in there positive with the dots underneath. And we're back to more of a deep purple now with the go, no-go system. So that's more decidedly negative. Longer term, still seeing some weakness with the 50, 150, and 200. Rate of change going back 200 periods, declining and also giving an extreme negative reading. And here's the longer term look where we came all the way back down to the COVID low, tried to bounce up off of that, but we've just kind of stalled out recently. Special K continues to decline. And the diamonds are now negative, as are the Qs. The Vixen increased on a down day, as to be expected, a little bit, but not necessarily spiking yet. It might have more room to go up. And the line chart also shows the advance. And the stocks that are above their 50, it's just kind of hanging out. We gave this signal before, bounced up a little bit, but we're not seeing any follow through. Same thing with the mid caps and then the small caps as well. Looking at the broad market, the CRB index really got hit. It was down 2.74%, and it's been down. We're still in an overall uptrend, but we broke through this 50 period moving average here. So that's what the markets, the stock markets, were picking up on and tried to recover from that, but it was kind of short-lived. The dollar was down a little over 1/3%, but is still in an overall uptrend. And here's the S&P to the dollar, which shows we are back to a neutral reading. Oil was down to 105.76. And the correlation is also, I'm still saying a little bit more towards neutral right now. Here's copper. We've just seen copper really fall lately. And I showed this chart a few days ago. We'll now have some more studies. This is the copper to gold ratio. So when this is going down, that means copper is underperforming and gold is going nowhere right now. So we're really seeing some weakness, and that could not bode well for the economy. And then we have the copper to gold ratio here, where copper is black and it's been declining. And then the 2-year yield right here, that is just showing how interest rates are going up as copper is going down. They do have a tendency to move more in the same direction with each other overall. Right now, we're seeing them going in opposite directions. Bonds, pretty much flat with the corporate bonds, about a 0.43% gain with the treasury bonds. World bonds were up 0.59%, so they're still showing a little improvement based on price. The S&P to the 10-year headed back more towards neutral, but still having a fairly strong inverse relationship. The tech sector to the 10-year also heading back more towards neutral, but still with a leaning towards inverse. Here's the 10 to the 5 yield curve, which is still negative. One thing that we did see here is this 50% retracement with the 30-year yield. It did break down below this as interest rates fell on Thursday, and this also shows how interest rates came down. Our scenarios, well, we have the Copic curve. It's starting to cross over. We don't really know if is that a positive or negative signal, and it's really kind of hard to judge right now. We have some positive things, we have some negative things, but this is coming back and crossing above the moving average. The equity put call ratio longer term, we're kind of spiking back up now, but we did that before. Just because we had one signal doesn't mean that it's all over with. Sometimes this can spike numerous times before we really do get set to see a change in prices. Here's the 200-day, still kind of bouncing up a little bit, even though it declined slightly. And here's the rotation that we're trying to see, but it's breaking down right now. Doesn't mean that this is gone, but it's just not holding up currently. But other times, you can see where it actually started to outperform here earlier in the year, but that ended up leading to nothing. So we just want to keep an eye on this. And then the next chart also shows how we're seeing a bit of a breakdown when we go with growth to value ratios. Then the 2-year spike, well, we spiked up and coming back down, but is this a spike? We don't know. We're seeing kind of an inverse relationship with the S&P and the 2-year yield, but it's kind of working its way back to neutral, but still more of an inverse relationship. We're getting nothing from this chart. I even thought about not even including this because we're just not really seeing anything. The staples, they were up slightly. So that means that we're spiking up again here. Are we going to take out this other spike? That could happen. And that would make this signal that we've been watching now for quite a while not valid any longer. So what's our outlook? The technicals, we have some possible positive setups, but they might be going away. We're just kind of watching them degrade every day as the week goes on. We have sentiment is extreme negative, so that could help support the markets, but we could camp out there for a while. We have ISM manufacturing coming out on Friday and construction spending, all the different geopolitical events and the Russia-Ukraine thing, supply chain issues, inflation, interest rates. That's the biggie. Margin calls if we keep falling. Oil, is it going up or is it going down? Earnings as they're released, the Fed speak as it's released, the situation in Japan, and then the recession fears as well. That's kind of becoming the talk right now until something more comes out of the Fed that we can latch onto that might help us determine what's going to happen with inflation and interest rates. So our scenarios, yeah, we're still down overall for all the reasons that I just talked about. The technicals, they're showing weakness again. How can we go up from here? Well, we need to see the technicals improve. And there is a disbelief that the market is ever going to go high ever again. We do have these positive scenarios, but they're not really giving us much right now. The sector rotation is not really happening right now. This could always improve. We're just not seeing it right now. And our technicals that we're looking at, we're below all the moving averages. Our oscillators are mixed right now. So we have to look at the pivots, the fib retracements, and then other highs and lows that were set as either support or resistance. And we're still, I'm saying we're not neutral because the ADX is still above 20 and it is negative, and it might be starting to turn back up if we see some more downward action. So our conclusion then is the S&P is negative, short-term negative, intermediate term negative, long-term negative. So there's really not much. I mean, there's some potentially positive things, but we need the charts to show us a little bit more positivity, is that even a word, to really latch onto those things. And they're just not happening right now. So thank you. Have a wonderful Friday. I will prepare the video for Tuesday because the market's closed on Monday over the weekend. And as soon as I can, in addition to the weekly video and the intermarket analysis video.